Welcome to Momentum Monday. Today is May 22nd, 2022. Howard, how do you feel about the market right now?
The market has uncurable COVID at the moment, as you know.
Monkeypox, right?
People know how I feel. I think I was looking back to when we first started saying the market was in trouble. It was like sometime in December. I don't know, like we've had, I don't know, when was that? So if I'm looking back.
It basically topped right around November when we started to see big breakdown in all the software names.
Hey, puppy. I got Lindsay here. Yeah. Oh.
So basically,
go ahead, take it away for a minute while I try and trap my dog. Take it away, Ed.
Yeah. So last week, all the major indices made new 52-week lows. The small caps, the large caps, Dow Jones, S&P 500. But interestingly, we saw some bullish momentum divergences as the Qs and the SPYs made new lows on Friday. We actually saw quite a few sectors, especially in the software space, which has been leading the downside. They just did not confirm that new 52-week low. They actually were quite a bit above it. So, you know, this is typically called bullish momentum divergence. Obviously, the trend is clearly down yet, but if we have to talk about the silver lining last week, this definitely was it. Just a lot of those beaten down software biotech names, they did not confirm the new lows on Friday. So we're starting to see a little bit of, a little bit decrease in correlations, which is typically a good sign. Obviously, it could be just another rotation, just how bull markets could correct through sector rotations. So bear market they also experience sector rotation here and there. For example, last week, finally we saw consumer staples, a sector that is considered a safe haven, just completely breaking down after Walmart and Target missed earnings estimates, guided lower.
Those are huge moves. Like Walmart,
yeah, down 20% in a day. Walmart's biggest down move in its history post earnings. So definitely it impacted the whole XOP sector. Like if people saw that they were safe just owning soup makers and soap makers, they were wrong. A bear market eventually gets to all. Yes, Howard, what?
Well, I think why there were such gaps is they were in denial themselves. I think based on what I was reading from hedge funds is people were hiding out there, of course, and the bear market's going to come for everything. That's what I've been writing about. Like that's just how bear markets work. You're nowhere to hide. But these guys were saying everything was okay.
Yeah, I mean, typically in a typical bear market, people hide in treasuries, but obviously this year this hasn't worked since every bear market is caused by a different reason. And in this case, the reason is that, the Fed's tightening policies, the removal of liquidity and just rising interest rates, this time are hitting treasuries, which are typically a safe haven during corrections. Usually treasuries and cash, this is where people go to hide, but cash is the only thing kind of working so far. And I mean, hopefully, yeah.
Hang on one sec. I'm going to try. I want to ship. Text me a code. Hang on one sec. Keep going. I'm trying to get in 44806.
So yeah. I mean, as I said, a lot of safe havens were hit. Like even Costco, like companies considered that is managed very well. Even they, they're down what more than 30% ahead of their earnings. They're
look at here's the trap. Is like, yeah. So if you look at the yearlies, I mean, it's back on some kind of long-term trend, but I don't know. This is a market where they were treated like growth stocks as well. And
it tripled since.
These aren't cheap. These aren't cheap for the type of growth they have. You know, it's kind of like been treated because of the club like a software company. But again, supply chain problems, there's no end in sight. This is not, so I don't know. And Apple's finally breaking too. I mean, Warren Buffett's going to step in here at some point and be buying Apple. It's his biggest position. And for a penny and for a pound, he's spending money the last quarter. So I think you got to watch Apple now for where Buffett starts saying, you know, I'm buying. The interesting thing about tech, and I wouldn't look at ARC, I would look to see there was some divergences, right? Like the Zooms of the world, some of the software companies are starting to just hold up as the market sells off. The problem is earnings are coming out this week for a lot of companies. So we could see the next, you know, if numbers are bad, these things will
Zoom, NVIDIA, Costco report earnings.
Yeah, this is a big week. And, you know, just because these stocks are down 70% doesn't mean they can't go down 80. I'm not betting that they continue to drop, but they're not cheap in a world where everybody needs some liquidity. The good news is there's cash on the sidelines. The other good news is, you know, rates have kind of factored in a lot of rate hikes already. So at some point this year, you know, with the election, the government will step in. I hate to use that as an excuse for people though. Like people have been conditioned to expect the government to kowtow to the market. And I don't even know if that would help this time around. You know, rate cuts aren't going to help the supply chain. Rate cuts aren't going to stop the Ukraine-Russia war. Rate cuts aren't going to stop COVID slowdowns. Rate cuts aren't going to solve, you know, China being shut to the US. So I think people looking for like some magic bullet here, I just think this is just going to have to work itself out. This is just a different market, you know? And we haven't seen one like this in so long. The 60-40 portfolio is obliterated this year.
Yeah, definitely. It's and people are finally kind of reconsidering passive investing. It was the past decade was the golden age of passive investing, and a lot of people are now kind of reconsidering, and maybe maybe a little bit of their portfolio should be in active investing. That's what a lot of people kind of moving. Like I always see that in my line of work, you know, after big market corrections, all of a sudden, you know, people decide to, you know, move some of their portfolio into active investing. Like every single time I see the same thing, like the most interest after corrections. And, but to your point, you know, the Fed admits that they cannot impact the supply chain and China and Russia, Ukraine. And this is why they're focused on.
It doesn't affect drilling either for oil. Like oil, you know, I mean, you see in California, what is it, $7 a gallon?
Yeah, over 7. Yeah, definitely.
Yeah, so the average American, or for a student, or for anybody living on a budget, their fucking budget has just been blown out of the water. I was saying this, like, if you're on some kind of fixed budget and you drive, and now they're asking you to come back into work, I mean, your utility and oil bill is like quadrupled. That's not like a 20%. We're talking about 300-400% move in the pump, and gasoline prices heading into like travel season for families is at all-time highs. These are not like, these are way over my pay grade. Like,
I mean, basically oil prices are doing Fed's job right now, so they're definitely impacting demand. They're taking away.
They are definitely impacting demand, and
the discretionary.
You know, prices are going up for food, so people going out to a restaurant, everything's adding up to someone living on a budget. So I was going to share my screen here. Let me share my screen and go through.
All right, go ahead.
Yeah, I'm going to share my screen and go through my Twitter feed with a bunch of charts that I've been sharing over and walk you through.
Okay, let me stop sharing so you can share now. Okay, now we're seeing your screen.
All right, so let me go to let's go through a few charts that I was sharing with people. This is a great one from Ryan Dietrich. You can see my screen, right?
Yeah, absolutely. We're seeing
How
it.
quickly after the S&P goes into a bear market does the bear end? Okay, so Ryan, he studied all the bear markets, and on average, he's saying, like, for a typical bear market, you're down another 16% in the S&P, which would mean the average stock's probably down 35% from here in the S&P. Now that's energy and banks. It's not just tech. And 5 more months of pain, okay, for the past 10 bear markets. Now, this is a bear market that's coming after one of the greatest Fed-induced tech booms of all time. So keep that in mind. So for people trying to call a bottom, so Ryan does the stats work on that. Okay, so that'll give you one aspect. The IPO index, which I talked about, IPO is a ticker. It's not very liquid, but the IPO index, this is another interesting indicator. You can see the last time we had a big drawdown like this, it was 2000. So, so we are at the beginning of what is a catastrophic, shutdown. This is what people need to understand. This is a catastrophic shutdown in markets after, a lot of these companies can't get public, which is another problem. So we're in a year here, Ivan, where bonds, the 60-40 portfolio is obliterated. If you're in the S&P, you're just noticing, if you're over 50, and let's say over 60, and we need these people to be investing, they're going to be in a state of shock in the next month. They're going to get their statement. And if they are in a 60-40 portfolio, they're down 20-ish% this year, which is real for someone, near retirement or near, where they're not accumulating necessarily from income. So their income's blown out of the water. Their savings are blown out of the water. And then if they've been going out on the risk spectrum over the last 3 years, because they had FOMO and they wanted to get into growth, they've been obliterated in the last 12 months, right? So that's going to change sentiment. We haven't seen sentiment like that where every category, and no one's long oil, right? It was not part of the S&P. It would have been obliterated to the point where it wasn't a factor in the S&P. So very few people are long oil. And because of ESG and no drilling, they're not going to drill. They're enjoying their gains in the oil sector, right? They're not investing because it's impossible to invest because they got to go deal with all the rules. So the IPO market is shut. And we know the last time that happened, that lasted for 2 or 3 years. The difference this time versus 2000, those companies ran out of money very quickly, like all those internet companies. This time around, companies have very high margins, and they may not get public, but they won't go out of business that quickly. So there's going to be all this kind of like dead money kind of companies that are overvalued and not dying. So it's a lot more supply to work through in the private markets, right? So this could last a little longer, but this, like for people comparing this to 2000, we're there. We may not be there in terms of pain, but we're there in terms of like drawdown. So that's the IPO market. Okay, next. And the IPO market corrects first, right? Because the market shuts, prices just drop, right? Let's see.
Yeah, there's definitely more supply as prices go down, and you can see that.
Well, all these kids that work for these companies, right? They've got to make a decision now. Do they pack up and go to a new startup where stocks get reset because now their options are all underwater? It's a great chart from Callum Thomas, and we can just see that even with this big pullback, growth valuations are still well above historic norms. So for people that don't think the beatings can continue, they can't. You can see in 2000, like we're just rolling over, right? So for those people that don't think value stocks like energy, I don't know if they're value anymore, but we can see the Walmarts and Targets and Costco starting to blow up too. So this is like really, there's nowhere to hide, as I was saying. So you still have a historically overvalued market. And then this is really an interesting chart that I've been talking about because my Bitcoin friends have been annoying for a year, telling me that I'm crazy to hold cash because it's losing its value. And we can see for the last year, it's been like probably the best hedge, just owning US dollars other than owning energy.
Yeah.
So these are the big problems. Like with the dollar going up, I feel like there's a crisis. We know there's a crisis ahead. We can't get baby formula, like supply chains aren't working. Kids are out there looking for work. They're underemployed, and the biggest expense, oil, is driving them, crazy. So we need the U.S. for equities to start running. We need the U.S. dollar to like slow down, if not reverse, and then we need rates to slow down to the upside. So those are the two things I'm really watching. Obviously, this week is a huge earnings week. I'm looking for a couple other charts that may have shared.
Yeah, I mean, stronger US dollar is basically worsening things, inflation pressures, especially for other countries.
It's just so bad. It's just, Europe's just such a mess. So this hurts us now too, because there's no demand from anywhere. And then here's Tesla, right? Like this was the strongest stock. Maybe Target, Costco, Tesla, and we lost the retailers last week. And now, Elon's, I don't know, distracted and like acting crazy and leveraged to the hilt with this stock on this Twitter deal. And you can see Tesla's, needs to kind of bounce in here, but it's broken, right? He was selling his own stock. So there's the leader of that tech boom rolling over and kind of crashing. So again, we're going to get a bounce. Let's put it back to you, Ivan. Let me stop sharing.
How do I stop sharing?
How do I do that? Oh yeah, stop share. So those are some of the charts that like I'm watching.
Okay.
Are you back?
Yeah, we're back. We're back to my screen sharing.
And then the new highs, new lows, right? Like it's there's not enough fear, and things are just breaking down. So whereas tech does feel like it's long overdue, like you showed the ARC divergences and some of the software divergences. The longer we go without a bounce, the more dangerous it gets, to be honest.
Yeah, that's
and then
correct.
If you look at the semiconductors, they just look like they're ready to roll over now.
Yeah, I mean, anything that hasn't been hit, definitely it's getting hit right now. Definitely, there's been a rotational correction as of late, not like a super high correlation correction where we would see a panic selling in everything.
Yeah,
which is the worst type of correction, because
I think this is the worst correction that I can remember.
Yeah,
because
it can last a lot longer. Yeah,
it's like that bull market that was awesome because it was rotating from biotech to staples to railroads. Like the railroads even are rolling over now.
Yeah, I mean, anything transportation, obviously, as their
the railroads were strong
as going up. So I mean, as you said, they're getting to everything in a bear market, no matter what. Even everyone's favorite big tech companies like Apple and Google, even they're down 25-30%.
Like I said, I don't want to be too negative because there's a lot of cash. There's been a lot of pain.
So where are you going, man? So you have a lot of cash.
Just high cash, but I know that's not going to work because the US dollar is about to get smacked, I think. And if it doesn't, to be honest, I'm screwed either way, because that means we're going down much harder. That means a crisis is at hand that we haven't even factored in, because people are just hiding out in US dollars.
Isn't that a great opportunity? Like if your time horizon is long enough, having a decent, good bear market is the best thing that can happen to you if you're trying to build wealth.
If you're 20 or 30, yeah, you should be rooting for another 50% down. What does it matter? Like, in the end, if you believe in corporate America and the way markets work, if you're young, stand aside. Nothing's cheap. You can start buying you know, the QQQ, I guess, or the SPY, or some Apple and some Google. Google's going to have a tough year just because ads will be down, right? That's, you know, that's the question is, is it going to 1,800 or 1,500, or was Friday the bottom? I have no idea. So at some point, if you're young, you can start layering into these on a regular basis, but these aren't cheap. Like, you know, this stock could easily go to 1,600 and be in an uptrend.
Yeah, definitely. I mean, during
It's
the
still
last,
be in an uptrend. So you've got to like, you
Yeah.
got to understand, you got to look at some of these long-term charts and realize that these were unsustainable valuations. And I don't know what the reversion in the mean looks like. I hate being negative, but like, you got to be realistic about this.
yeah, I mean, obviously, I mean, with your age is a little bit normal to get a little bit more defensive and more, you know, realistic. But during the last big bear market that lasted like a couple of years in 2007, early 2009, the best companies in the world, like Apple and Google and Amazon, even they went down about.
And they had already bought you,
65%.
and they had already bought YouTube. Yeah, they had already bought
Yeah.
YouTube, and it still fell how much? 500.
65%. But I mean, the S&P
So
went down 66%.
For Google, a 60% drop would be 1,800. You know, and we're a long way away from that. So
even less than that, like even under 1,500.
Yeah.
If obviously if it's something similar.
Yeah.
But even just pulling back to its, what is this? I think it's 20 months moving average. That would be around what, 17.
So if you want, if you're ants in your pants and you need to buy stuff, you got to ask yourself, will you be willing to add more at 1,500? You know, all things being equal, right? Story not changing. So that's how I ask people to do it. Like, if you're willing to buy it tomorrow, you're willing to like double down when the stock gets, you know, down to its 200-day moving average. You know, the bear markets require patience. What are you doing, more importantly, because you stare at a screen all day? So
yeah, I mean, I continue to do just short-term trades, stuff that is intraday or just 2 to 3 days, just because the market is very volatile. It's we see big reversal, as you saw on Friday, you know, when everyone was just getting super bearish, like during that big drop on Friday, and then the last hour it was just like a big push higher. Like those type of market can be very volatile. You need to be very nimble if you participate.
Yeah.
So yes, there are good opportunities, but you need to be nimble. And if you're not nimble, it's just better to stay on the sidelines with cash and just be 100% certain that this big correction is going to offer you an incredible opportunity to find stocks that and crypto probably that are going to go up 10 to 100 times after this is over. Yeah. So you just need to protect your capital, because your time will come and you'll be able to build, you know, to change your life and build a generational wealth after it's done. But you need to, you know, survive it whole. And not to, you know, have to climb out of a big hole if you just, you know, continue to do stupid things and own stuff that keeps falling.
If tech is your thing and it's my thing, in 2000, what, 1990, Cisco peaked at near $1 trillion, right? It was going to be the first $1 trillion company. And then it took 18 years for there to really be $1 trillion company, forgetting Aramco, but so, and then there were what, $10 trillion companies or $8 trillion companies, or maybe just 5. So put that in perspective, but there were hundreds of $100 billion companies. So this correction is going to take time. You know, we were going through a 0 interest rate environment. So the spreadsheet has changed, right? Now people are going to have recency bias, right? Next time rates start dropping again, people are going to say, oh, remember, you know, so recency bias plays into effect, and that will affect, you know, you're not going to get a V bottom because of recency bias. Now, because of the pain and the length of this pain, you're not going to get a V bottom. So it's going to be very different than the last corrections.
Yeah, I mean, there's something called like a self-fulfilling prophecy during bear markets. And I mean, you already mentioned about the private companies, how they'll have issues keeping their best talent. And public companies are going to have the same issue, because now they'll have to give more options and stocks to their employees so they don't leave for Google and Apple.
They're already doing it. Coinbase, which I'm long, which is a disaster. They already promised to issue more shares. So this becomes
exactly, they'll have to do it so they keep their employees, which will dilute.
dilutive. This becomes dilutive.
Exactly, and yeah, I mean, this is why longer term downtrends, they kind of become self-fulfilling prophecy as companies need to increase supply in a way so they can keep the talent. And
the one thing that's interesting is, will there be acquisitions? So that, and those are hard to play, but the one sector that looked pretty good is the drug sector. And the question is, will they use their balance sheets to buy a lot of these biotech companies? So you've got Bristol Myers, Merck.
Yeah, Merck is probably the only one kind of all-time highs right now that is looking good. But yeah, they have a lot of cash, and they'll definitely have some acquisitions in the sector. I think
PPH is the ticker for the PPH, Paul Henry, for the drug index ETF. Yeah, and then generally the defense sector does pretty well. But again, I mean, you're just gonna have to like keep an eye on. I'm keeping an eye on the all-time high list, and there's nothing there except the drugs, which is super defensive.
Yeah, I mean, we're seeing some positive developments in those what are they called, like ALB, LTHM, or the metal stocks, that lithium stocks that provide for the solar and for electric vehicles.
Yeah,
Since this is a big trend, definitely holding a little bit better, but obviously in a weaker market, they're not gonna go far. Yeah. But definitely showing relative strength. Like the moment the market lifts, they're likely to be among the leaders.
If demand drops, these things will get hit so hard. These are so. People buying expensive cars and things is one thing, but if demand pulls back, these things just get hammered because they're so leveraged. So again, the setups look good for sure, but I'm saying in the end, if you're truly looking for growth, it's pretty slim pickings. But you're right, there are some things that look.
Yeah, I mean, obviously with the rising oil, it kind of makes sense the demand for electric vehicles to increases, and Tesla is the best-selling vehicle in California for last year. Not the best-selling electric vehicle, the best-selling vehicle period. So the trends are changing in that direction. So there's a lot of demand for those plays. But you're right, on the all-time high list, there's slim pickings. Energy is still the one sector that is holding really well. And
it's up almost 50% this year, so it's not. So congrats.
If this is a typical bear market, eventually this is going to get hurt too. But we are in a special circumstances, so we don't know.
Wouldn't just drop. These would drop 30% quickly because that's just they're thinly traded. So these can drop very quickly. So be careful. Yeah, be careful. All right. Well, it sounds like you're just high cash.
Yeah, high cash overnight for sure, and just mostly short-term trading. The occasional intraday short-term swing. I'm not doing really anything aggressive. I just try to make a little bit money here and there, and just keep a positive attitude, and knowing that this current correction is just laying down the foundation for incredible returns down the road.
Yeah, this is all about staying in the game because it thins out the herd, and growth. It's just America. Growth returns, but we've got a lot of supply to work through, and there was a lot of bad. I mean, I was ground floor at a lot of this, watching it, and there was just the stuff was so overpriced, and it was funny because I was just watching it and it was working. Anything overpriced was going up, so. We're all guilty. You can't blame anybody. It FOMO'd everybody in. And there was lots of time to get out. I mean, like the SPAC market was March, and then there was Solana summer. And, Tesla didn't really peak until later in the year. So there was like 6-7 months of churning, you know, and so it wasn't like there was no warnings. But for people that don't think Tesla can trade quickly to 300, you know, I don't think they haven't been in the markets long enough to see real pain. And Musk has shown his vulnerability with his leverage, and hedge fund, these things happen. You know, bear markets can go after the richest person in the world. We know that from reminiscence of a stock market speculative from history. Leverage, you know, leverage and bear markets can work their magic in reverse on people. So number one thing is in a bear market, unless you're a lunatic, get off leverage. And who is the most leveraged person? The richest guy in the world. So it's an interesting moment in time. So I think you got to be really patient here. But there will be some terrific bounces. It's just for really good traders here.
All right, Howard, thank you.
All right, everybody, have a great week.
Yes, see you next week.
See you, Lindsay. Say goodbye.